Good morning, everyone. Welcome to the weekly Commodities Outlook. My name is Sriram Iyer from the Commodity Research Desk at Reliance Securities. Starting with the gold side of things, this week, international and gold futures fell over the past week with lows of for the MCX continuous contract at 60,191 levels. Of course, prices were weighed down by a stronger dollar and a rise in the benchmark US Treasury yields. Additionally, Fed or Hawkish Fed speak over the past few days have also kept prices upside limited. Most of the members believe that the inflation still remained elevated, and the Fed had needs to do more to cool inflation. They have also ruled out any rate cuts this year, and they said that the bank was not at a point yet where it can hold rates steady for a period of time. So the speech has been extremely, or I should say, on the hawkish side of things, and that has definitely weighed on sentiments for bullion side of things. So investors have continued to factor in that there could be a rate hike in the month of June as well, despite markets showing that CME Fed Watch tool showing that there could be some kind of a pause by the Fed. Prices did initially find support earlier in the part of the week after US Treasury Secretary Janet Yellen warned about a US default that could threaten the global economy. The negotiations continued this week with no clear indication of when or if, even if it's going to be solved. So I think some support was taken on the back of that. But looking ahead for the coming week or so, we feel that gold prices and silver prices can continue to struggle. We have the important comments by the Fed Chair Jerome Powell on Friday, and he could talk on several things like the Fed monetary policy stance, of course, but he could also talk on the US debt ceiling issue, which has been plaguing the market for the past few days, and his comments will definitely drive the markets going forward. Of course, a hawkish commentary on the future monetary rate hikes can be a negative for the bullion market. So I think till that time we feel markets can remain range bound going forward ahead of that. After these comments, though, markets will look to data ahead. We have the US GDP number next week, along with the Fed favored inflation gauge with the PC price index and the durable goods order. So I think after that we can see the markets moving themselves or aligning themselves ahead of that important data points next week. So markets can remain range bound. On the charts, we feel that the MCX June contract could find support close to 60,000, but a close below that will pull the prices all the way down to 59,500. On the upside, we need to see a clear break above 61,000, possibly on a weekly. From a weekly perspective, we need to see a clear break above 61,500. Then only we can see some bullishness to the markets. For the international markets, we continue to see the range between 1970 to 2035 intact ahead of that Fed speech. But after that, the ranges could vary going forward depending on what he says. Briefly on copper and crude oil prices, both struggle in this week. Especially copper prices have been extremely weak. In fact, the industrial metal has fallen close to 4% in this week, primarily on the back of weak numbers from China. Investors had hoped that the reopening of the economy could improve the situation in that country. However, over the past 3 months, the industrial activity has weakened, along with other weak numbers on the retail sales and the fixed asset investments, suggesting a sluggish economy there. The recent inflation numbers also from China has reflected a deflation kind of a situation, and could possibly seek out some fiscal or monetary policy support before stabilizing going forward in that country. So I think we can see some more correction for copper prices at least in the short term basis, and any rise can be met with some selling going forward, at least in the coming week. On the crude side of things, we see the markets have been range bound over the past few sessions. Of course, the negatives of markets overall bias still remain negative for the crude oil prices. Weak demand, rising inventories in the US continue to keep prices under pressure despite slightly bullish demand forecast by OPEC and in the IEA over the past few weeks. But we investors are worried about the US debt ceiling, and the failure to reach the deal could see the US default, an unprecedented default, even though, and that will have a definite negative impact on the crude oil prices going forward. So I think both copper and crude, along with bullion as well, we see more correction. Of course, the dollar has been recovering solidly over the past 1 week, and further uptick of the dollar will definitely keep all the commodities, dollar-linked commodities, under pressure going forward in the coming week or so. So that's it from our side. Thank you very much for listening. Have a pleasant day and a week ahead. Thank you.